Yeah, let's get started. All right. Welcome, everyone. Thank you for joining the panel on the next Growthpole of DeFi. I'm Stanley from MetaWeb. So this panel is part of a MetaWeb research initiative called the Future Finality, which consists of a series of panels, interviews, AMAs, and research articles on the most trending topics in crypto. So apologize for my voice. This flu season is really not kidding. So I'm super honored to have our panelists here today. We have Guillaume from Panoptic, we have Laura from Ledger Prime, we have Xin from Uniswap, and we have Tarun from Gauntlet Network. I think we should start from everyone introducing themselves. Let's start from Guillaume. Yeah.
All right. So hi everyone. I'm Guillaume Lambert. I'm currently the founder of a options protocol called Panoptic, where we do perpetual options on-chain based on Uniswap v3.
Hi everyone, my name is Laura. I run BD and strategy at Ledger Prime. We are a quant fund mostly focused on derivatives.
Hi everyone, my name is Xin. I'm currently a researcher at Uniswap Labs.
Hey, I'm Tarun, founder at Gauntlet. We do risk management, DeFi. Yeah.
Cool. All right, let's get started. So actually, I want to start with a more broader question. So obviously, we know DeFi has seen exponential growth since 2019 and 2020, but also the growth rate slowed down a bit after the market downturn. And if we look at it right now, DeFi still dominates crypto trading. So my first question is, what's stopping DeFi from getting bigger in terms of liquidity and volume? And also, we know that institutional money is the biggest player in both TradFi and crypto. And in order for DeFi to get bigger, we need institutions. So how can we accelerate the onboarding of institutional money to DeFi in order to get it bigger? I think we can actually start from Tarun for this question. Yeah.
Yeah, I mean, I think the number one thing is we probably need more actual stablecoin users who are using stablecoins for things other than pure leverage. I'm not sure if that means that you need non-USD stablecoins, but it's very clear that stablecoin velocity dropped a lot in the last year versus where it was maybe 2 years ago. And the money velocity piece is actually quite important to keeping DeFi flowing. The second thing, I guess, is privacy, although I'm still not convinced that the average DeFi user cares that much about privacy yet, but the average institutional user does. And so somehow bridging the gap between custodial solutions that do offer you trade privacy, at least partially, versus fully decentralized things that don't. I think that's going to be a big portion of where DeFi goes over the next few years, probably mainly driven by MPC and ZK's innovations.
I think the largest driver of institutional volume, at least in TradFi, is actually probably speculation. And the DeFi infrastructure is just not made for institutions to speculate on price returns. And so I'm not sure if that's something we should actually be building for, okay. Are we building the system to be the best casino for institutions? But that's kind of what I see, the fundamental driver of a lot of the volume is institutional speculation, and DeFi is kind of not made for that. So.
Oh, that's a very practical view. All right. Yeah, Laura?
Yeah, I just wanted to add, I think you just brought really good points to the point where the last few months I've been thinking a little bit more about this, why do we created this? Why did we come here? At first was to remove the central player as well as to provide financial access to everyone, right? And with the incentives through tokens and stuff over the past few years, everyone getting greedy, we've lost that part a little bit. And to play a little more like devil's advocate on the institutional side, there's a lot of people are not going to like what I'm going to say, but there's really no way to get more institutions without some sort of permission protocol or more regulation KYC around it, right? And I think that if both sides work together, the crypto native and regulators, we can find a middle ground that everyone will be sort of okay with. You can't have, it's not black or white. Even with any topic in life, it's never one thing or the other one, right? And we've been playing this war of I'm right, you're right, when nobody's right. We don't know what the right thing is, and working together is the only way to figure this out.
And to add on this, I do feel like the current DeFi protocols we see may not be attractive to institutions. 100x leverage, the swaps you can get are okay if you're degen, but if you're managing hundreds of millions of dollars, this is not the way to go. They need other tools, they need other approaches. And I think, as you say, we need to meet in the middle, but also we need to upgrade a little bit or elevate what we can offer. The bulk of the institutions aren't interested in 100x leverage. They just want stable, secure yield. If you look at it from the outside, the blockchain may seem scary and dangerous, but it's the safest thing that exists. It's cryptographically secured. So it's safe. It's just the perception is not that it's for the larger funds or those that may seek a more risk-averse yield.
Yeah, great. So Tarun mentioned stablecoin and privacy, and Xin mentioned that probably institutions will just speculate on fintech exchange, and both I think both Laura and Guillaume actually mentioned that institutions may want something else, something we probably still don't have right now in DeFi. So personally I'm more curious on the infra side, right? So since I think some of you mentioned probably we actually have to build something else, right, for institutions for them to actually come to DeFi. So what type of infra, either trading infra or as Laura mentioned permission protocol, what type of DeFi infras do you most expect to emerge in the near future that can really accelerate this whole process? Maybe we can just start with Tarun again.
Yeah, I think if we take a more historical look at how crypto financial markets develop, a lot of the early centralized players actually came out of giving miners excess financing, right? So a lot of people were borrowing against future block rewards. Mining pools came about to try to lower the variance in expected rewards for each miner. And in a lot of ways, we're starting to see the same thing happen for staking. The fact that liquid staking is now larger than DeFi, the rest of DeFi, sort of tells you that people really want financial services around validation, and that's going to be the native infrastructure type of piece that people want. I think as people start to build more things, say like EigenLayer, where you can build more complex restaking logic, that type of infrastructure is probably going to be what drives the crypto native growth over the next probably 1 to 2 years. I think another thing that probably will be a form of sort of natural demand in DeFi is going to be data availability and people basically paying for data that's on a foreign chain, so on a rollup, data that's on a foreign data availability later, like Avail, Celestia, EigenDA, etc. So on the native side, there's actually a ton of infrastructure that should be driving natural endogenous demand that doesn't need external institutions.
I see. I think it's interesting that you are saying those more fundamental blockchain infras like restaking and data availability, and you think those blockchain architecture level innovation will actually drive more demand in DeFi.
I mean, liquid staking is the greatest example of this, right?
Right.
The market growth there tells you that people who are staking want financial services much more than almost everyone else on-chain right now.
Exactly. Yeah, that's interesting. And then maybe we can, Xin, do you have anything you want to say?
I don't have a systematic view. I just anecdotally have heard that a lot of concerns related to compliance, regulation, KYC has been, one of the obstacles. I don't know if that's solvable at the infrastructure level or that's solvable through more clarity around some of these rules or something else.
Yeah, I think.
But yeah, that's just my anecdotal.
Yeah, I think we definitely need that. I mean, I think those are definitely part of the infra too, right? Laura?
I guess following up a little bit with my previous response to what needs to be built in terms of infrastructure, there's a lot of projects that after the FTX collapse have switched more towards hey, we actually need to bring code into law, right? So for instance, in derivatives, bringing ISDA into a smart contract, or finding another way to build this bridge between both sides that we can. In that case, regulators will also not have a say, right? Because hey, this is your piece of law that we're putting into code right now. So what do you have to say to that, right? With that, a lot of exchanges are also moving into like decentralizing the custody side. It's very interesting to see what some of the major ones are looking into. So I think this year we'll see a lot of development in that span.
And I also want to add that this is a panel on derivatives, and a lot of what DeFi has been doing quite well, thanks to Uniswap. Of course, it's the swapping. You can spot trade very easily. You don't have to worry about the price, loss order. This is a piece of infrastructure which I believe has been solved. You can improve a little bit, but the spot area of finance has been more or less solved. We still need stable yields, so the liquid staking derivatives, the tapping into the yield of staking is one way to create something that's stable. Perp futures is another layer that you need. The perps allow you to access leverage, they allow you to hedge your positions. This is another infrastructure that people have been working on. And what I see that's missing as a core infrastructure that's huge in TradFi, which is options and options derivatives, whether it's exotic options or regular options, we don't quite see it yet in DeFi. And that's kind of the missing piece, or the missing pillar, if you want, of finance. Futures, yield, spot, they have their own role to play. Options has its own role to play as well. So even if institutions don't necessarily come in for yield or spot, they may come in for options and do, again, what they do best. So I feel like the slowly but surely over the past 5 years, we've solved some of these issues, and maybe options, it's the last one that's a little bit tougher to crack. But that's how you can create the more complete infrastructure that can satisfy everything that happens in TradFi, a good options offering.
Thanks. Yeah, I fully agree that we definitely want, I would say, more sophisticated infras, and that can cater for more needs from both infra and retail sides. So I think we've talked about infras, we talk about institutions. I think I want to switch gears a little bit because I know we definitely have a lot of DeFi degens here. So I really want to ask a question that many DeFi degen and retail users care a lot about, and which also actually I would say triggered a very lengthy debate on crypto Twitter, and that is AMM LP liquidity. AMM liquidity provision profitability debate. So for those who don't know, there are some independent researchers who actually did research on LP on Uniswap and made the conclusion that LPs are losing huge money by providing liquidity to AMMs. And of course, there is another camp of builders, researchers, DeFi users who have a different view. So for me, I really want to hear your take on it because I know like Professor Guillaume, like like Xin, and I think Tyrone too. I think you're actually actively evolved in this debate. So because AMM is such a fundamental infrastructure for DeFi right now. And I think it's probably the only protocol that everyone uses every day. And if LPs are losing money, and then that actually makes things look worse on DeFi, right? So how should we actually perceive this question? And if it's true, then what things should we do to actually improve the experience of retail users in AMM, and to maybe help them earn more money or at least lose less? So I think we should start from Professor Guillaume this time.
Yeah, sure. So again, the argument goes that AMM is difficult. It's reserved for the sophisticated players. The retail users that will go in these pools will lose collectively millions of dollars every year. And to some extent, I'd say that some of it is true. When you LP into Uniswap, you choose a pair that you want to LP into. Most folks go for ETH stablecoin. ETH USDC is the most liquid pair because everybody is LPing there. But it turns out that you also have to be smarter as to where you deploy your liquidity. There's 6 or 7 ETH stablecoin pools. They don't have the same yield. Some of them have lower liquidity. Some have a lot more liquidity. But they all follow the same price feed, the centralized exchange on Coinbase for the ETH price. So the analysis that looks at ETH USDC, which is the over-liquid pool, everybody participating, the return per unit of liquidity is lower than ETH DAI, for instance, or ETH USDC. And if you go to the ETH token pairs, I'm a huge LP myself. I have hundreds of positions I've managed. I never go in the ETH stablecoin. It's too boring. You will go ETH Shiba, ETH Uni, ETH Aave, all of those that have some volatility, some activity, but they are deemed too risky for liquidity to go in. This is when you can be a bit more successful. So at the end of the day, I would say these points are well taken that it's difficult, but you have to be smart as to where you want to go if you want to LP.
I'm going to ask you back a question now, because you mentioned a lot of things that the average user just doesn't really know about if you want to get more towards adoption of a retail user, right? So these are things that are pretty sophisticated. If they get into a low liquidity, high volatility pool, the impermanent loss there, I mean, how many of us have suffered from permanent loss, right? So how can we teach newcomers about it, or how can we get them to, think about all these things? There's a lot to learn here.
Yes, exactly. And I think I'll give you an anecdote, but yes, impermanent loss is then you start with a token pair. One token goes to zero, you start with the token that has lower value. My view, at least, and what we do in Panoptic, is that providing liquidity is similar to selling options. It's not market making, it's not passive yield, it's actually selling options. And the anecdote I want to tell you guys is that I trade options in TradFi. This morning, I had a short put in Silvergate Bank, the bank that went 60% down overnight. And I suffered impermanent loss.
That's awesome.
But I know the risks. I know how to manage those trades when it's options. I would do the same way if it was an LP token. But now people come in, it's like level 400 trading. When you come in, naked puts, very, very dangerous. When you do it in TradFi, you have cash secured put, you can buy protective wings, you can create a spread to limit risk. So the key point is that vanilla LPing is difficult, but it's not impossible. Folks in options trading know how to manage these positions. And impermanent loss, the only way you can beat it is to have a smaller size. I had one contract in Silvergate, I lost 600 per contract, but that didn't bankrupt me. If you put all your funds in this one pool and it goes down, you can go to zero. So that's kind of the spread. But yes, the key point, impermanent loss is manageable if you think in terms of options as opposed to just passive, let's put my money there and wait.
All right, so Xin, you're from Uniswap, and you heard what Guillaume said, right? So is this a vision that you personally agree with on, or let's say in the future, right? So all LPs on Uniswap basically just becomes professional option sellers, and what's your take on that?
Well, first of all, disclaimer that all opinions are my own and not that of the labs. I think so. The debate has been going on for a long time, and I think the consensus is, as an LP on AMM, at least as of right now, you do leak some value to arbitrage flow compared to sort of a hypothetical scenario where you don't, right? Exactly how you achieve the scenario that you don't leak any value while being LP on AMM is still, I guess, a very widely researched topic. There's been proposals for dynamic fees, for example, or for auctions at block level, et cetera, et cetera. So I think that's kind of the consensus is you do leak some value, but your alternative is hypothetical right now, and there's no exact thing you can do to achieve that alternative. On the other hand, I do think the proposal by Guillaume is somewhat valid. Like the payoff represents or is similar to that of an option, at least for some pair and for some specific implementation, right? If you read the white paper of Panoptic, is it out? It's out? Okay, yeah. So it shows you how you can replicate a perpetual option with out-of-range LP positions, which I think is very intellectually interesting. And then there are people who LP on Uniswap and actually make money. I'm not saying this is ex ante true, but the fact that there are people doing it means, look, you have to be competitive if you're going to LP, right? Like the difference between being a Uniswap LP versus TradFi is you don't necessarily have to start with $10 million. You just have to be smart. But it doesn't mean you can just deposit money and enjoy high return, no risk, right? So I guess the main difference is now you just have to be mentally sophisticated.
Yeah, so you hear Xin, so Uniswap is just a platform, and I'm pretty sure everyone here is smart enough, to make money LP on Uniswap. And Tarun, I know you are probably the best modeling expert in DeFi, and you've been working with top DeFi protocols, and you are more or less I would say a more objective observer here. So what's your take on this question?
Yeah, so I think there's like a benchmark issue. So like let's actually go back and look at the history of passive investing. So this is like an epistemological fight that's been going on for the last 30 years in almost all of finance, which is, does it actually make sense to have large pools of capital allocated passively into things like ETFs, into things like passive funds, or does it make sense to have active funds? And it's actually been a very cyclical thing. In the 2000s, active investment funds were like the highest performing asset class by a long shot. All the passive investment funds didn't work. But after the financial crisis, people just started plowing money into ETFs. And then suddenly ETFs became a much larger portion of the overall equities market and then took over in some sort of bizarro fashion. And then, of course, we had sort of like the retail boom from 2019 to maybe last year, which also sort of became active again. We kind of went back from passive to active. So there's sort of these market regime shifts historically where a large portion of the investing community decides that actually passive investments are easier to deal with because, like maybe you're actually sort of optimizing for like long-term returns versus sort of, immediate cash-on-cash measurements. And so I think a lot of the Twitter fight is sort of people spending a lot of time arguing about two very different benchmarks. One person's benchmark is the infinite time portfolio value of a liquidity provider, which is the long time limit of like what the value of the portfolio should be. The other is sort of like the rollout, markout type of thing where I pick a finite observation window and I say, this is how much I should expect to make, right?
Yes.
Those are two very different benchmarks, and it's exactly the same distinction between people who believe in passive investing versus people who believe in active investing. And at the end of the day, there's no real true passive investing. Because like there are a ton of people who make money off ETFs because ETFs are inefficient. They don't track their indices perfectly. But yet people still want to buy them because it's a much easier place to park their money than actually having to think a lot. So I think you have to like understand the utilities of all the different participants and the fact that we have these secular shifts between passive and active investing that change over time.
Yeah, I agree. I mean, I think that's a very, very, very good point, especially the comparison between passive and active, and also I think you mentioned that obviously people are arguing about two very different things, right? And I think I've seen arguments on that actually using market to market as a methodology to evaluate LP P&L on Uniswap, it's somewhat irreasonable. And I think that's probably like a point made by Professor Guillaume. So I think you once said like LPs are not really market making on Uniswap. It's the protocol, right? It's the smart contract was actually market making, right, on Uniswap. Yeah, I think that doesn't make sense. And I think we can see that even among our panelists, there's still not like a real consensus among our four panelists. So I think it's a really interesting question for us to further dig into. But today I'll just stop here and I'll ask my final question, and that's going to be about derivatives. Because the reason why I asked about AMM LP is because obviously that's the first way, almost the first way that DeFi users start to generate yield for themselves. And also, we know that GMX has led the trend of the so-called real yield recently, and it's been, obviously one of the top trending topics in crypto right now. And obviously, in GMX, the real yield is provided by derivatives trading. And Professor Guillaume, you're working on derivatives in crypto. Like, I want to ask everyone, how, because I know Laura, you're super knowledgeable in derivatives too. Like, because in DeFi, everyone loves passive management. Everyone loves passive liquidity provision. We just want to park of money there, and that's it. Like in GMX, we just buy GLP and then 20% APY in Ethereum. That's it. So how compatible do you think derivative is, with this DeFi sort of trend of passive investment, and how far do you think derivatives can go in DeFi? Let's start with Gil.
Yeah, I mean, my thesis is that derivatives will go in DeFi because they are needed. You need stable yield, you need futures like product, you need trading, you need options. The users may think they need something, but for the rest of the world, you need some like core primitives to work with. And the point about being passive, you think of it as a risk-free endeavor. You don't even manage your trades. You'll get a risk-free rate, which is the basic basement level you can get. If you want to take more risk, you get more reward. But there's no free lunch to some extent. I mean, with GMX, there might be a point where what seems to be risk-free may be exposed to some level of risk. If you want to be extremely risk-averse, you go on staking yourself, your own node. If you want to be extremely active, you go trade on the futures exchange. But it's a spectrum. And again, there's no one place for all. If everyone wants to be passive, you'll get the risk-free rate. And that's what you have to kind of come in terms with, because you cannot beat the passive rate by doing something that doesn't require any work, for instance.
Laura, I think options is right up in your valley. So
I agree. There's definitely no free lunch. And with this, I also want to add that there's no opening a position and hoping that another day you're logged back in and then suddenly find 30% there or whatever. Last year, I was a big supporter of DeFi option vaults and the development of those, because I think that's a really great step towards adoption of increasing volumes, right? There's no market that, if you look at like TradFi and crypto markets, the ratio between spot and derivatives is very different, right? And in crypto, you have that options are like a few basis points of the total volume. Perps account for like 50% or like more, and then the rest is like split between spot and futures, right? But we need more derivatives to be able to replicate this risk. And then I personally like options a lot because it's easier to kind of determine risk in terms of like the breaks and expirations. But for instance, one of the issues with the DOVs is that it is supposed to be a retail product, but then you're loading your user on deltas that they don't know how to manage. And the day that there's a little bit of like market volatility, all of the gains that you've like been piling up for the past few months are gone, right? And that will push people away. So we need to engineer better products within derivatives in DeFi, and I think that's the next step that we're missing.
Cool, thanks. Xin, I know you're from a spot exchange, but tell us about derivatives.
I feel very strangely about derivatives because, or at least the framing of the question, because I don't think anyone in like DeFi derivatives is in pursuit of like real yield. It's more like in pursuit of 10x tomorrow. So I think the feature set that you optimize for is different when you build a product. But yeah, I don't have a good view on where the real yield is in DeFi. So.
Okay, that's fair. All right, Tarun.
Yeah, so I think there's a couple things. The first thing gets back to what I was saying earlier, which is validators actually need a ton of derivatives. In the same way that miners were the #1 consumers on the sell side of a lot of derivatives, both on perps and in options in the early Bitcoin market, we see kind of the same thing. And staking derivatives are just one way of kind of providing some of those. I mean, that is a derivative. It has a sort of very weird construction. It doesn't replicate something that looks like a normal traditional finance market. But there's a sense in which that is the #1 used derivative, and that's the thing where people are really, that is real yield, right? It's people who have ETH staking yield and want to 2x it. And in crypto, that probably is the only real fundamental source of yield that exists right now that's tied to transaction demand. But I think another thing about TradFi that you have to remember is that in the normal market, large institutions are the large-scale buyers of options and futures. So, there's sort of the sense of like big ETFs, big commodity houses, people like that, they have a ton of risks to hedge, and they're willing to take huge transaction costs for like long-time derivative exposure. In DeFi, we don't have that because farming doesn't have anyone who has long-term, long-time scale exposure and is willing to put extreme size. And I think the key of the next cycle is that DAOs are going to be the biggest need to become the biggest participants in this market because they are the equivalent of large institutions in traditional finance that take one side of the large derivative trades that we see. So I think you're servicing two people if you're being honest. It's validators and it's DAOs, and that's it. And you need to get them buying a lot of derivative.
Okay, we hear you clearly. Validators and DAOs. All right, so we're already running out of time, so I have to wrap up here. I want to thank you everyone for joining the panel. It's been amazing, and thank you thank you everyone here for listening. And don't forget to follow MetaWeb on Twitter and Medium for the latest update. We're gonna write an article on this. So yeah, I think this is it for today.
All right, thanks
Thank you.
everyone.
Thank you.